Hello everyone, and welcome back to my channel. In today's video, we're diving deep into the recent banking crisis, its potential implications for Bitcoin, and the enormous test and opportunity it presents for the entire crypto industry. If you're interested in the world of finance, cryptocurrencies, and how they're shaping the future, be sure to like this video, leave a comment, and subscribe for more updates. Section 1. The Historical Context. Cyprus Moment. Let's start by looking back at the historical context. 10 years ago, during the Cyprus banking crisis, a strange new digital currency called Bitcoin caught the world's attention. With a 10% tax imposed on withdrawals, Cypriots began to explore the idea of bankless digital money. Fast forward to today, we're witnessing a similar scenario, as Bitcoin's price surges amidst stress among US and European banks. However, the context has changed significantly. With crypto now embedded in the public consciousness, often negatively, the industry faces its biggest test yet in the struggle with the financial establishment. Section 2. The current banking crisis and its effects on crypto. In recent news, we've seen the collapse of three high-profile banks, including Silvergate Bank, which had heavy exposure to failing crypto firms. This has led politicians like Senator Elizabeth Warren to call for tougher measures against the crypto industry. As fear spreads, depositors are fleeing to Wall Street's too-big-to-fail institutions, further centralizing power among elite bankers. The government's actions, whether intentional or not, are putting a squeeze on the crypto industry, making it harder for them to open alternative accounts. But what exactly caused this banking crisis in the first place? In 2009, the Fed launched a multi-year quantitative easing program to revive growth. This led to a surplus of dollars, which venture funds poured into startups. These companies deposited their funds in banks like Silicon Valley Bank, SVB, which then invested in long-term U.S. government bonds and mortgage-backed securities. However, when the Fed began hiking interest rates in January 2022, the bond market crashed, causing massive losses for SVB and other banks that hadn't hedged their interest rate risk. Section 3. Bitcoin's potential amidst the crisis. Despite the negative news and association with the banking crisis, Bitcoin's self-custody model and predictable monetary policy could prove more attractive if people continue to lose confidence in banks. The appeal of Bitcoin may also increase if the Federal Reserve reverses its course and cuts interest rates, potentially weakening the dollar. This highlights the multifaceted power struggle taking place, one that will likely compel governments to accelerate the implementation of new regulatory frameworks for digital money. Section 4. The need for a new regulatory framework. This banking crisis emphasizes the need to divorce payments from crisis-prone fractional reserve banking, a solution that fully reserved stablecoins can provide. One way to ensure the stability of stablecoins is requiring issuers to hold banking licenses and access the Fed's discount window. However, this could provoke a larger banking crisis if depositors leave traditional banks for crypto alternatives. Governments may need to strike a balance to prevent further destabilization of the financial system. As the debate over the future of stablecoins continues, it's essential to consider the broader implications for the financial industry. If stablecoin issuers were to hold banking licenses and access the Fed's discount window, it could lead to a significant shift in power dynamics within the banking sector. Traditional banks may push back against this change, fearing that their depositors will flock to crypto-based alternatives, thereby reducing their ability to provide loans and maintain profitability. As a result, regulatory agencies will need to carefully craft new policies to manage the potential fallout and maintain stability in the financial sector. Section 5. Central Bank Digital Currencies, CBDCs, and their implications. As governments consider implementing CBDCs, they might offer targeted interest rates to incentivize people to keep their savings with traditional banks. However, cryptocurrencies like Bitcoin can still stand as hard money alternatives, pressuring governments to adapt to the digitization of money. This dynamic could force governments to rethink their approach to monetary policy and financial regulation in the digital age. In the race to create a digital currency, some countries have already launched pilot programs, while others are still in the research phase. China's digital currency electronic payment, DCEP, system, for example, is already in use in select cities, and the European Central Bank is working on the digital euro. The United States is lagging, but the Federal Reserve's recent report on a digital dollar indicates that they are taking the issue seriously. CBDCs have the potential to revolutionize the financial landscape, but they also raise concerns about privacy, surveillance, and government control. As we move toward a more digital world, the balance between convenience and control will become increasingly important, with governments and central banks needing to ensure that citizens retain autonomy and privacy in their financial lives. Section 6. The challenge ahead for the crypto community. While crypto faces a significant mistrust problem, it's crucial for the community to engage in behavior that breeds confidence. This includes promoting transparency, collaboration with regulators, and focusing on real-world use cases that provide tangible benefits to users. By doing so, the crypto industry can seize this unique opportunity to redefine the future of money and transform the global financial system. One way the crypto community can foster trust is by working closely with regulators to develop clear and comprehensive guidelines for the industry. This will not only help to establish a level playing field, but also ensure that businesses and consumers can operate with confidence in the crypto ecosystem. Additionally, the community must address concerns about money laundering, terrorist financing, and other illegal activities by implementing robust compliance and anti-money laundering (AML) programs. Another critical challenge facing the crypto community is scaling and adoption. For cryptocurrencies to compete with traditional financial systems, they must be able to handle large transaction volumes and offer a seamless user experience. Projects like Ethereum's transition to Ethereum 2.0 and Layer 2 scaling solutions are working toward this goal, but more work is needed to ensure that these systems can meet the demands of a global financial network. Section 7. Conclusion and Future Outlook. As the banking crisis continues to unfold, Bitcoin and the broader crypto industry face their most significant test yet. While the crisis may present an opportunity for cryptocurrencies to demonstrate their value as an alternative to traditional banking, the industry must first address the challenges of regulation, trust, and adoption. In the coming years, we can expect to see continued innovation in the crypto space, as well as increased collaboration between the industry and regulators. This will be essential in paving the way for a more inclusive, transparent, and decentralized financial system that can weather the storms of future crises. That's all for today's video, folks. I hope you found this deep dive into the banking crisis and its potential implications for Bitcoin and the crypto industry informative and engaging. If you enjoyed this video and want to stay updated on the latest developments in the world of finance, cryptocurrencies, and technology, be sure to like this video, leave a comment, and subscribe to my channel. And as always, thank you for watching, and I'll see you in the next video.